You have a strategy with an 80% win rate on paper, yet your live trading account is bleeding money. When you scroll left on a chart, your brain naturally locks on to the perfect setups. You see a massive bull market, spot the exact moment the moving average is crossed, and tell yourself you would have taken that trade. That hindsight scrolling completely ignores the cost of doing business. You aren't calculating the spread, and you aren't accounting for the slippage that occurs when your order is actually filled in live conditions. We are going to build a mathematical, bulletproof backtesting system. I will walk you through the exact protocol to verify if your strategy actually works. Step 1 is gathering your tools. You need a rigidly defined set of trading rules, charting software with a bar replay function, a blank spreadsheet, and raw historical data spanning from 2021 to 2025. Until you run your rules through this specific gauntlet, you do not have a statistical edge. You are just gambling on hope. Your rules for entry, stop loss, and take profit must be strictly mechanical. We have to eliminate gut feelings entirely. We start with the in-sample test. Turn on the bar replay mode in your charting software and set the date to January 1st, 2021. This hides the right side of the chart, forcing you to trade the raw, unfolding data up to the end of 2023. You will now log 100 consecutive trades. If the setup meets your mechanical rules, you record it. Skipping a setup because you don't like the price action ruins the math. Amateurs click arrows on past charts. Professionals log the date, entry, stop loss, and risk to reward for every execution. When a perfect setup hits the stop loss, write that losing trade down. Erasing it destroys the test. During this phase, you are a data entry machine. You execute the rules and log the outcomes, no matter how ugly the sequence of losses gets. Now we apply the reality tax. The theoretical profit on your chart does not equal the cash in your broker account because the market charges friction on every execution. Add 2 columns to your spreadsheet. Deduct broker commissions and subtract 0.08% for slippage on every entry and exit. Watch what happens to a break-even trade. After paying spread and slippage, it becomes a net loss. Step 4 is out-of-sample verification. You take those exact same rules and run them through the untouched data from 2024 to 2025. If you start tweaking your moving averages now to avoid the losses you just logged, you are curve fitting. Curve fitting is overly tailoring a strategy to historical data so it looks perfect on paper but fails completely in live conditions. If your system bleeds money on the 2024 data, the test is over. You scrap the strategy entirely and start from scratch. This chart shows how to track your maximum drawdown. You combine both data sets and measure the deepest percentage drop from your account's highest peak down to its lowest valley. Finally, you calculate the mathematical expectancy of your system. You multiply your win percentage by your average win and subtract your loss percentage multiplied by your average loss. If your system survives the reality tax and stays profitable through the out-of-sample data, you have an edge. If it doesn't, you have a curve-fitted fantasy. Staring at the final spreadsheet can be a heavy moment. The massive profits you imagined have been ground down by the math. You will likely find that a legitimate, robust strategy produces a win rate closer to 45%. The 80% win rate you see advertised online is a myth. Watching your simulated account suffer a 15% drawdown on a spreadsheet is a necessary rite of passage. It trains your mind to handle the exact same sequences when real money is on the line. Logging 500 individual trades row by row is tedious and unsexy. It stands in stark contrast to the quick riches sold to retail beginners. But that completed spreadsheet becomes your psychological shield. When the market spikes and you feel the urge to chase the price, the raw data keeps you anchored to your rules. A backtest does not predict the future. It proves that your execution has a mathematical advantage over a large sample size. Stop clicking arrows on past charts. Start logging the hard data. Operate like a professional instead of betting like a gambler.